we are officially live on Facebook for the Thursday edition of the Not Your Average Investor Show, the JWB Rental Property of the Week. Today, we're going over a property that you can lock in lower interest rates today than tomorrow, and it's going to earn 12% returns. We got our guest investor segment today. I am your host, Pablo Gonzalez. GC is not with us today. We got the EY award. It's kind of the size of his face. It's heavy. So he, taking up a little bit of space. We got our fabulous community manager, Madison the Magnificent, with us today, helping you out in the chat. Say hello, Madison.
Hello, everybody.
And our guest investor today, we were just talking about it, straight out of Columbus, Ohio, had a exit of a company not that long ago. He's doing pretty good. He is a stalwart of our community, wearing the baby blue Not Your Average Investor Show shirt. He is the early bird of the IRL meetups because he's the first guy in the door. We got to hang out with him, got to meet him, got to befriend him. Dean Curry, welcome to the show, my friend.
Thank you very much. Great seeing you again. And you were in my fine state, just not down here. So
I was in that city that we don't like to name on this show. Cleveland.
Should not be named.
And I want to welcome you if you're listening on the podcast, if you're watching on YouTube. We love having you here. But there's a little secret to this show, and it is that it's more fun when you join us with our friends, become part of the roll call, become part of the community. And you do that by going to nyais.com, registering there, goes on your calendar. You can show up whenever you want. But normally what happens is that when somebody shows up, they stick around because of the roll call. You ready for the roll call, Dean?
I am ready. Yeah.
Roll call time. Madison's first saying, welcome to the Not Your Average Investor Show. We got Denny Davis from Germany saying Guten Tag. We got John Hanning, our leadoff hitter of the chat, usually saying good afternoon, all. We got Drew Barnhill, the ringmaster of the Not Your Average Investor Show community from Atlanta. We got Bill Shields with his Buenas tardes, amigos. Buenas tardes, Bill Shields. We got Chris Gonzaga from the illustrious Hudson Valley, New York. We got our regular Rosalind Riley saying good morning, everybody, from Murrieta, California. We got Tony D, Anthony Dida from Jupiter, Florida, checking in. We got Nadeem Shah with his trademark. Hello, good morning, good afternoon, all checking in from the West Coast. We got Pedro from Jersey checking in. Welcome back, Pedro. Good to have you. We got the guy that everybody knows his name, Noah Randari. Hello, everyone, from greetings from California. We got the patriarch of the first family of the Not Your Average Investor Show community and matriarch Ken and Carolyn Moline. We salute you. Who else we got in here? We got Aaron O'Neill checking in. Aaron, I love saying your name. You were used to not engage in the chat. Then we met at IRL, and now you're all in. I love it. I'm going to keep saying your name. I love that. And who else? We got Gerard. Gerard Wendling is back. Gerard, good to have you back. We got Marilyn Cotterman from Homosassa, Florida. Did you know what happens there?
Yeah, it's a home of the manatees, I believe.
The manatees. One of the manatees, the original nickname of the Not Your Average Investor Show. And we got David Singy checking in. Good morning, good afternoon, all from San Diego, America's finest city, they say. And Jen Filzen, the fairy godmother of the Not Your Average Investor Show community, checking in. And Bill Oxley hanging out with us on Facebook. Bill, it's always good to have you on Facebook. Let us know whenever you want to come in here. We like to have you here live too. Oh man, that's a great. I feel like that's one of my more efficient roll calls with a lot of participation. I really like it. But my favorite segment, Madison shares good news. Tell us what's good, Madison.
Hey, everybody. All right. The good news today, it is the end of the month. So what does that mean? Client tours. So we get the honor of meeting some new clients. The oldest client we have coming has been a client since 2019. So we got some newbies. Super excited to see them, meet them, talk to them. We got Ron Finney, who has been a client since this year. He owns 2 homes with us. We got Adrian and Walter Brown. They own 1 and they bought their first property this year as well. And then we got Itzel Alicia. She owns 4 homes. She runs something similar to what we do in South Carolina. But she has been a client and bought all 4 homes in 2019. But that's not all the good news I have.
There's more?
Yeah, there is.
Yep.
For the client tours, super good news. We got word from the Jacksonville Business Journal that both JWB Property Management and JWB Real Estate Capital have made the list of 50 fastest growing companies in the First Coast.
There you go. There you go. Nice.
And that's because of you guys.
Oh.
Not just because of us. So testament to you guys putting your trust in us. We love you.
Not one, but two of the fastest growing companies in-house here at JWB with the awesome team that y'all have and the awesome community that helps us grow and helps JWB grow. Madison, that's good news. I like the setup of good news as much as anything else. All right. So thank you, Madison. Favorite segment, but the star of the show today is our guest investor, Dean Curry, joining us from Columbus, Ohio. Dean, you're a pretty experienced investor. What do you got going on these days? What kind of investments do you have?
We have, well, we're thrilled to say that we have 25 doors overall. So including duplexes and all that kind of stuff. We have, most of them are single family. We do have some duplexes wrapped in there, but no more than duplexes. So of course we have our stuff in the stock market, which is always a fun ride. But once we found real estate investing, we bought our first property in 2013 and really haven't looked back. However, the most recent relationship with JWB, I think we started it sort of at the end of last year in doing some solo K type non-recourse lending. And I know that tab has been taken off of the property of the week, but it's still a viable way to do it. And I was talking to Pablo beforehand about how we actually leveraged some payments, just leveraged some homes that we paid off and used those to buy our first two properties with JWB. So leverage.
We're definitely going to get into leverage today. I know that you're a lover of leverage. So you said 25 doors under management? You got 25?
Yes, sir. Yep.
That's awesome, man. That's a heck of a little portfolio right there. You've got, 5 that you own. You just closed on a 6 in Orchard Street, and you got another one under contract for mid-August. So soon to be 7. And I am pumped to pick your brain. Denny Davis is asking, how quick do you think Dean hits 50 doors? Is that part of the plan?
Well, I was telling Pablo that we did some 1031 exchanges. So we sold 2 properties here in Columbus because the market's so insane that it enabled us to buy 4 properties with JWB. So, we could do that a couple more times and we'll get there.
Not too shabby. All right, Dean. So right now, let's jump right into the property and show everybody your guest investor chops. We're going to magically whisk ourselves away here to 8047 Hammond Boulevard in Jacksonville, Florida, 32220. It is a new construction property. As you can tell here, this is a representation of the floor plan, but the characteristically sunny Jacksonville sky. Purchase price of $235,000, 3-bedroom, 2-bathroom, and what our investors tend to come here for, right? The estimated conventional ROI when financed of 12.08%. Dean, when you are, you've gone through this show, not the show, you've gone through this examining of a JWB property 7 times now. What's the first place that your eye goes to?
Well, I'd be lying if I didn't say the purchase price, but quite honestly, I look at it because that's the thing that's bolded the most. However, you have to look at the IRR. I mean, that's overall, especially the way the stock market, inflation, all that kind of stuff's happening right now. It is what it is. And, I look at the 2-car garage, which I think is a huge rental opportunity there. I do see this is on septic. And I do remember a show that I listened to long time ago, must have been a podcast, about a really cool program that JWB has for people that are on septic programs. Because I've always strayed away from septic in the past just because I had always heard horror stories about issues you can have with septic systems. But now that you have a program that allows for that to be mitigated, that fear to be mitigated, I think that I would have no problem looking at a property like this in the future.
Interesting. I love that, man. That is a telltale sign of somebody that's been paying attention, right? Like the septic program that they brought in that came from JWB's innovation department, right? Like that we had a whole session about how JWB takes their whole team and puts them in groups and thinks of how can we make things better? And this was one of these team generated ideas. I love the recall to that. I also forgot, normally I have GC here and normally I ask him, what does he love about this property? And GC, being the very prepared person that he normally is, he sent it in ahead of time. So he puts here that it is brand new construction, which means lower maintenance and vacancy costs. And in order to take advantage of lower interest rates right now, putting a property under contract that is already built or renovated. That's a problem for most investors who are stuck on waiting lists, of pre-construction is not a problem with JWB. You can put this thing under contract and immediately lock it in at these rates that we know are showing us that they are going up. Right. So that's actually something that became really real to me at this conference that I went to this week in Cleveland for holdcos, right? Like guys that invest in other companies. I was asking them about real estate, and some of them were real estate investors, but they were having a real hard time, finding properties to invest in. Right. So like this idea that JWB's never had a waiting list. For the first time, I started getting data points outside of our community about that. Have you, Dean, you've invested with other companies, right? Like, did you ever encounter a waiting list scenario? Was that kind of what brought you here, or how did you end up? I guess I'm about to ask you 10 questions, but have you ever encountered the waiting list scenario?
We did, and it was with a different turnkey company, which then allowed us to start looking at other options. I reached back out when I started in 2013. It was my money. It was my wife's and I money that we were using to invest. And then I think a lot of us are all of the not your average investors came through the Fortune Builder program, as did we, and heard about JWB, but didn't know anything about it. So started doing my own research, listening to these podcasts, seeing how relatable people were, talking with the onboarding team. And yeah, the fact that there was no waiting list and the mortgage rates were so great at that time. Yeah, that definitely brought us over. Now, the other company is great. One of the things that really turned myself on and my wife on to the idea of turnkey investing, because, I've never been to Memphis, Tennessee, but I've got houses there. And people are like, how can you invest in a place you've never even been to? But it's that mind shift that you have to get through to understand that. But this other company said this, and it really got my attention, is that they said that if my wife and I have to spend more than 4 hours a year doing stuff related to these properties, then they are doing something wrong. And that really stuck with me. I mean, obviously there's a lot of time when you get set up and you got to go through the whole process of buying the property, the asset, and that type of thing. But, after that, the very first property we bought, you're quoted on what the annual lease is going to be, the amount. How dare JWB, the very first property we had, they got a 3-year lease and they got it for $200 more per month than they said they were going to do. Gosh darn it. Right.
Yeah.
And I don't have to worry about it now. They just do what they do, which is fantastic. So.
That's pretty awesome, man. That is one of the things, as I've become braver of like calling myself a real estate investor these days, now that I have 3 and talking to people more about real estate, I think it is a very commonly held belief, right? Like that this doesn't exist. Like this idea, these super high expectations that they set for you of, only having to spend 4 hours a year and be a rental property owner is something that most people don't know that that's available to them, man. So I think it's interesting that they set that expectation in the world of turnkey. It's pretty much held true, right? Like outside of like the setup and maybe some smaller moments in time, that's been able to happen, right?
Yeah, completely. I mean, it's just, and then we instituted some of the plans that Fortune Builders told us, in which we talk about here, where 2 of the properties we bought were in cash and the other 2 had mortgages. And then we just started applying those principal only. Those are non-recourse retirement funds. I'm not at retirement age yet. So I look at it like there's not anything I can do with that money now anyway. So just plow that back into the principal. And using that process, we ended up, before JWB, we bought a 5th property in Arkansas. I've never stepped foot in the state of Arkansas, same type of thing, but it all comes back to the management team and using the tools that are there. The education is just amazing. So we ended up paying off 2 properties in Texas, again, managed by the same company. And then we used that money, not the money, we refinanced through a new company that JWB pointed us to, Sierra Crest, Bob Cash, amazing guy. Jennifer, his team is great. We did cash out refis on 2 non-recourse properties that were paid in full, and use that money to put down our first 2 properties with JWB.
Awesome. So
again,
are you
money I can't use anyway right now? I mean, don't get me wrong, I'll need it down the road, but right now it's sort of like oh, let's move this over here and put this over here. And boom, I got 2 new properties.
So those first 2 that you got with JWB was under non-recourse. Like you said, we've taken the non-recourse tab out of this because it's a small percentage of people and it kind of confuses them. Can you explain a little bit what the non-recourse kind of like investing process is like?
Well, in a non-recourse type thing, and again, I'm not C or CPA. Talk to the ringmaster about all the technical stuff. But I had a business that I owned for 20 years, and I had a single employee pension that I was putting money into. And then I converted that into a solo K, and actually had to set up a different company for it. So it was basically our company. And then when you do non-recourse lending, the gist of non-recourse lending, as I understand it, is that when you do a conventional loan, so I'm living in a house now, and I had to personally guarantee it, and they check my credit, and they do all that kind of stuff that I'd make sure I was capable of buying this and paying for this property that I live in. But in a non-recourse type of thing, you're putting down more money typically. It used to be 50% of whatever the cost of the asset was going to be. I think in some cases they can lower it to 40%. And I don't know what those ramifications or what those reasons are why one over the other. But the gist of it is that for me is that this was our retirement money. We were able to buy it. Yeah, we had to put more money down than conventional. But right now, the way the mortgage rates are going up on conventional, it's almost a better deal, despite having to put more money down initially. The interest rates are almost the same right now, quite honestly. So again, it's retirement money. And once you understand the concept of leverage and all that kind of stuff, it's amazing what it can do for you when it's amazing what it can do for you, and all the expenses and all the management fees and all that kind of stuff are handled, and I don't have to worry about it, which is, again, goes back to that 4 hours a year. So
yeah,
I don't know if that answered your question directly, but it's
yeah.
non-recourse is a great way for people that have retirement accounts that they just don't want to have it sit in a 401k waiting to see what happens. So.
Yeah, totally. That was very new to me when I joined this community. The concept of like, you can invest in real estate in your retirement account, and it's called non-recourse, and it has these wonderful kind of like scenarios that Dean is talking about. If you're able to do it, it's got to be totally contained in there. The other big misconception, Dean, that I keep hearing from people is, not just I can't be a real estate owner without plunging a toilet, but people are just like, well, I look at the cash flow, and then at the end of the year, like, I'm thinking about it, and I think of the things that I've done, and is it really making money? And I find that people don't really understand the 5 profit centers. Can you give a shot at kind of when you think about this like 12% IRR, how do you think about the profit centers that come out of this thing?
Well, on the 12% IRR, I mean, the biggest thing is that these properties are going to have people living in them that have been vetted by JWB and met all of their standards for the type of tenant that they want. So I understand, Pablo, we talked, you may have an eviction coming up, and that's going to happen. I mean, nobody's perfect. Mm-hmm. And you don't know what the situation is related to that. But on average, they're going to have a really, really good tenant that is going to be paying for all of this stuff. So it's not just the mortgage that you're paying down. It's they're covering the cost of the insurance. They're helping you make a property that's depreciating. There's tax benefits. There's all of these things that are built into this thing. And besides the initial investment, I don't have to worry about. And they're also building up equity in the amount of product of the asset that I own, so that in my earlier example, by doing a cash out refi on a non-recourse property in Texas, allowed us to buy 2 new builds with JWB. First new builds we ever had were with JWB.
Yeah, that's awesome. So, yeah, I've been going on podcasts recently and talking about it, man. But it's like, it's fascinating. People don't understand that it's like cash flow is one of the 5 things, right? To what you're talking about, right? Like if you are cash flowing positively on a month-to-month basis, that allows for the other 4 to kick in without, and you have somebody doing it for you, then these other four things kick in without added stress. You mentioned debt pay down, right? The idea that your resident is paying down a loan. So, worst comes to worst, you're still gaining that equity, which eventually turns, well, I guess I don't have to get there yet. There's also tax savings and the idea that you can depreciate the cost of the actual physical house, not the land, over 30 years. And that causes this like non-cash tax deduction that is able to save you some money on taxes, which is another profit center. There's the idea of inflation hedging, which is becoming a more and more of a bigger thing as the consumer price index hits like 9 and 10 and all these different things, and gas is going crazy. And then there's appreciation, which, as Greg likes to explain, is the idea that, in the short term, you don't want to be banking on appreciation because you have all these other things with closing costs and whatnot. But if you're in it for a full market cycle, which we estimate to be 10 to 20 years, then you can count on the historical appreciation rate of a home kicking in over that time period. And Jacksonville, out of all these like cash flowing markets that, satisfy condition number one, happens to have way more of a higher appreciation rate over the last, historical appreciation rate. So it is a great place to buy and hold. And then what Dean is talking about is this idea that because he's been in it for some time, that combination of debt pay down and appreciation in other assets, that equity that he gains in the house, he's able to take that out and then go buy other rental properties, which is what I'm hoping to get to here in a couple of years as well, because I'm in the beginning of my journey. Is that pretty good synthesis there? That's
great. And you nailed it. And the other thing that when they put out this property information through your account rep, they base it. One thing that I really, really appreciate is the under promise and over deliver. Because right now, Jacksonville, what does Greg say? We're at a 22 to 23% appreciation, in a year. It ain't always going to be that way. Excuse my French. But if you look at this thing here, the appreciation rate is calculated at 4.6, which is anything else. If one company has a shortfall and we can't use that money anywhere else. So you obviously have to have a cushion, which we keep. And I think Greg talked about that a few weeks ago, of having $10,000 to $15,000 cushion. So it's not like we take 100% of the money and all put it toward principal. So we have that cushion, and then we're just hitting it that way. I don't know if that answers your question, but that's
totally. Yeah, that's awesome, man. Yeah, because I'm just trying to think of when and how I start doing that. I guess now that I'm at 3, I should just basically take all the cash flow that I have, total, anything left over, and start applying it there. Is there something to think about as long as should I also be putting any extra savings that I have into that stuff, or do you just contain it all in the property deals?
I try to keep it within the property. I try to have each asset class try to stay in its own lane. Now, that being said, I told you before that I did sell a company recently, and I was able to use some of that cash to apply toward maybe down payments. But leverage, using some money for down payment, and then again, once you have your cushion, because you're going to have issues. You're going to have issues. I mean, I've seen unfortunate reasons here in Columbus where the property manager just really failed to do something. And quite honestly, I finally got in to see this property, and I was horrified. And my wife and we decided to sell that property so quickly because the last thing we needed, quite honestly, was some news station saying local investors, blah, 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 now have this, house in this condition. I mean, it was horrible. Wow. And I'm really frustrated just because we don't have a good relationship with this management company up here. So, we're trying to we're not trying, we're staying above board. Everybody, the person that taught me about it, real estate investing back in 2013 was our first property. I realize there are Class C and Class D neighborhoods, whether it's in Jacksonville or in Columbus, but he taught me that everybody deserves to have a safe place to live. Now, it may not be in, the Class A neighborhood. And I understand there's people going to live in different areas based on their income and their ability, but everybody deserves a safe place to live, no matter what class you're in. Yeah. And once I got through that, then, I think it changes your mindset and understanding where you're investing. I tell people, I've got 7 houses in Jacksonville. Oh, that's awesome. You're gonna live in one? I'm like, no, These are not properties that I'm going to live in. They're not even near the beach that I know of. I've only seen them a couple of times. Got a beach down there, right?
Yeah. I go there often.
Yeah, right. Yeah, just brag. Okay. But no, seriously, they're assets. They're a means to an end. But now my wife and I, we don't have any children, but we have lots of nieces and nephews. We've got our living trust set up. All of these things are set up so that once we move on, then these assets will be able to continue to provide for them going down the road. So that's the education we're trying to impart on our nieces and nephews to show what an amazing real estate adventure can be if you surround yourself with the right people, i.e. a JWB or people that know what they're talking about.
That's really cool, Dean. You know, my wife and I don't have kids either, and I'm like a professional cool uncle, but like, I think I'm going to be really cool if I leave them like a real estate portfolio.
Yeah, right.
Right now, I just take them surfing and it makes me cool.
It's like, you get a house, you know.
You know, Leslie Wilson is saying something in the chat, which is, I think, is what you're really talking to. It's this idea that it's the property manager who really makes you the return on your investment. In everything that you're saying, it sounds like your investment journey has largely been dictated by something we talk here a lot on the show, that it's, you know, most people think, you know, what property am I going to buy? And then they think, what's the team I'm going to put there, you know, to manage. When we talk about it a lot the other way around, it's like, find where you have a great team to manage something that you can trust, and then go, you know, and then like figure out if that's the market for you. And then, you know, the property last. Have you learned that by experience, or this is kind of like what you were taught and you've stuck to it and it's worked for you?
No, they're exactly experience. Again, my window was strictly Columbus. Now, I've lived here all my life. I don't plan on living here my entire life. Once I retire, I hope to go somewhere else. I don't know, but Columbus was my focus, and it's what I know, and it has amazing growth and. But until I got the education about tax savings, and I mean, I just did it because, yeah, I mean, in Columbus, it's going to cash flow better than there in Jacksonville. So, you know, the best property I ever had, cash flow wise, literally bought for $7,500. Did you know you can't get a mortgage on a $7,500? I'm just kidding. So I put like $2,500 into it, made it livable, and that thing rented for $850 for 9 years a month. I mean, it just constant. It was great. That property was a part of our 1031 that we just did. We bought it for $7,500, basically did no maintenance just because it was a great tenant. We just sold that property for $85,000, I believe.
Phew.
And then was able to, again, flip those around, work through an intermediary. It's all, you have to do it the right way because IRS, you know, they want what they think is their money. But we were able to leverage that and put it back into 2 new properties in Jacksonville.
Nice. So I feel like you've talked about a couple different leverage things. One is refinancing the homes that you had in Arkansas. Is it that you then got
Texas?
And the Texas homes that you then got your first couple of properties with JWB. Then you've also now talked about a 1031 exchange, right? Where you took 2 properties and bought 4. Is that what I'm hearing?
Yes, exactly. So basically, again, consult your tax attorney, but a 1031 exchange basically allows you to sell a property. And, you know, if I paid $7,500, and I realize there's depreciation and other calculators in there, but if I was going to make a $70,000 profit on this property, then I would have had to pay capital gains to the IRS because of that. Well, one of the great things in the 1031, this is a code, I believe, and again, talk to the ringmaster, but I think it's been around for about 100 years. So this isn't something new that just, you know, was cropped up in the last couple of administrations, but allows us to, through an intermediary, to take that full $70,000, hold it somewhere else through like an escrow type thing, through this intermediary. And then the people at JWB, they send the contracts over. They say, okay, we need this amount of money for this house and this amount for this house. And then it's all done. So the money never came to me. And it can't, because as soon as I touch it, I got to pay capital gains on it. So it all works. And again, the people, the McKillop law firm that we work with, the JWB does all the closings, they know their stuff. They've done this a lot of times. And you just work through a qualified intermediary and they handle all that stuff. And again, it's just a way, again, to continue to leverage the money, using other people's money.
Yeah, that concept of leverage is when I really started clicking for me, this whole asset class, right? Like, and it probably took me about a year of Not Your Average Investor shows to really get it. So I love talking about it because I think it's the one thing that I find people most miss about real estate when they're like thinking about, well, I'm thinking about just cash flow or whatever, but it's like, no, man, it's the ability to like build this thing and be able to gain interest off of other people's money in a completely ethical, legal way, right?
Oh yeah,
and
completely legal. And again, I know Greg's talked about this. Other people say, the bank isn't going to allow me to take $100,000. I only have to put down 20 for me to go out and buy stock. It ain't going to happen, right?
Yeah.
But they will let you do that with a house.
Yeah.
And I'm like, okay, fine. So long after I'm gone from this world, I know that what I've done now will continue to be able to help people in my family down the road. And then with a team like JWB, making sure, things are going to happen. Tenants and toilets, right?
Yeah.
I joke, I said, I don't like to fix my own toilet. I don't want to fix my tenant's toilet. Let somebody else do that.
Yeah.
And if I can get that through and still have all of this fun stuff, it's great.
Awesome, man. Well, we're going to dive into your portfolio in a second, right? Because Greg put together the This Is Your Life snapshot. But before our call, you mentioned two people in your life that weren't crazy about this stuff initially. The first one was your financial planner, right? Like, talk to me about that conversation with the financial planner when you decided to go through this, because I think that's going to happen, right? Like, people are going to talk to their financial planner. They're going to be like, I don't know, man, I got this thing. So how was that conversation?
Well, that was fun, and I cringed, but it was fun. And he's still a planner, and he still does some stuff with us. But yeah, I mean, I had because I own this business, and I was able to put in, and again, talk to your tax advisor. You can do something as a single employee business. I had a single employee pension, so I was able to put a significant amount of money over 20 years into this thing. So I had a pretty good chunk of change. But again, it was just sitting in some mutual fund that I don't understand, and I know there's people in this organization, whether it's with JWB or Hervé or people that live those worlds, it was beyond me. I didn't understand it. I just did what I did. So when I learned that you could convert or take some of this money out, and I had that conversation and I was really educated on it, and I had a lot of stuff, the planner said, well, you don't want to put all your eggs in one basket. And, every dog has its day. And all these different things. And I realize he's going to lose whatever commission he made on that money, but it just, it was what it was. So it was an unfortunate conversation. And probably the guy that originally told me about real estate, he talked to me about it for probably 5 years before I ultimately did it. But one thing that he said to me, he says, I always have troubles with financial advisors because they never look at real estate is a way to add that to your portfolio. It's always something that's just over there. Those people deal with real estate, and that's not really a part of your financial plan. And sure enough, I would take him to different my guy's different. I'm going to introduce you to Bob, and Bob's going to say, no. It's the same thing. Bob was like, every dog has its day. There's going to be issues. And, look at the stock market. Financial planners aren't really popular right now. Market's down, 20% or whatever the number is. All the properties that I have here, my rate that I'm paying is the same. And it's going to be the same for the next 30 years or whenever I pay it off. And rent's going to continue to go up. So even though cash flow isn't as good right now, that's okay, because I don't need it right now. So real estate can be something that you can, I'll say, leverage not just money, but leverage time. And when I get to the point where I do retire and I'm going to need that money to live, then all of those properties currently, I think we are at 7, maybe 8 properties in the non-recourse space. will hopefully be paid off. And maybe I don't need all that money, so we can continue to leverage. So it's a great deal.
Love it. Love it. Hervé says, Dean, you're 100% on. Many financial advisors don't understand how real estate can positively impact a portfolio. Plus, they don't get commission for adding real estate deals to your portfolio. So why learn the product? Dean, the other person you said is even more important than your financial advisor, and we kind of had a moment about this before the call, is you said something like, yeah, I keep refinancing and getting more properties, and my wife kind of hates it. What's that conversation with your wife like when you're doing this stuff? And what do you think is the pain point for her? What is she missing, or what does she not like about it?
I gotta be careful because this is being recorded and she's not watching it now. And I know she's going to watch it later. So I love you, Nan. I love you with all my heart, but it's just what you know. I mean, I sort of handle this and she's an amazing help. So behind me is her desk and she keeps track of all of the rents and deals with the property managers. And I say deals with, we don't have to deal with JWB. We don't have to deal with this other company in other places, but we have to deal with the stuff that's here. It's always, and so she's really, really instrumental there. But I think where her catch up is just the initial amount of money. You put down 20%, and closing costs are what closing costs are, and the interest rate is what the interest rate is. But she just wants to make sure that we can continue to live day by day. And, now we go back and we look at it. I'm like, hey, honey, we just sold these 2 properties that we're doing really well, but now we can do this. And at the end of the day, what is this going to be as we move forward? So I think it's just more of maybe the concern, is it about initial cash crunch and not being able to live the way that we've become accustomed to living? And we can still take those vacations, we can still do those things we want to do. But, her dad, my dad, they were of the age where you work for the same company for 40 years, you retire with your gold watch, and then you live that way.
Yeah.
And I just didn't want to do that. So, and we didn't want to do that. So I think the initial thing is just the initial, will what you're doing in real estate hinder what we are trying to do right now?
Yeah.
And once I can try to get her to thinking about, it's not just a house that we own somewhere else, it's an asset. And what is an asset? And without getting into schooling, because you can't, well, I'm not going to go there. You just can't, once you understand what an asset is and when you buy it and it continues to throw off money on average on the upside, there's going to be issues. There's going to be evictions. There's going to be turns. There's going to be things that, well, none of my markets until JWB were in a hurricane zone. Guess what?
Yeah.
It's hurricane season down there, right? Never had to think about that before. But again, looking at all the different things that are there and the insurance companies and all the companies that JWB tells me that I should work with have been spot on. And I think by educating Nancy, my wife, Nan, on that type of stuff gives her that peace of mind and making this thing a better deal.
I think you hit on it exactly right. I think there's a really valuable conversation. I'd love to know in the chat if other folks are having this issue, right? Like you are one half of an awesome team and you kind of like see this investment and it's a tough conversation to have with your other half. And I think you nailed it, man. Like the stuff that I'm going through with my wife as we are, in the middle of like one tough resident situation, we're buying another one. And I know that we have a potential turn coming up in November. So there's like a couple of these like moments of inflection where what you said comes true. The idea of, hey, if we're going to have to shell out some money right now, is that going to hurt us in living our life the way we want it? And the immediacy of that concern outweighs the, outlook of like, yeah, but in 10 years, I'm buying 2 houses for free, right? Like, which you've kind of done. And we're having those conversations right now, right? So I'm like, I love that I got to have that with you, because I think that's you hit on the pain point that I hadn't really identified. And it's just like, what's happening today affecting our life. We got to address that. And that has to be clear of like, is that really going to affect our life or not? And then what is the value prop of allowing it to affect our life a little bit, because later down the line, we're going to have all these other options. I think you said that really, really well.
Yeah, I think, and we went down and visited, I think JWB for the tour that Madison was talking about earlier, beginning of this year. And once she saw the team and met all the people, and it was just like, this is so much bigger than just the two of us. And all of these people have the same goal of trying to maximize the return. I want the property manager to make money, because if they're not making money, then they're not going to be doing it very long. So I understand, but I want everybody to understand that profit is not a dirty word, and it enables so much stuff. So I want to be profitable. I want Pablo to be profitable in his business, and JWB, of course. So yeah, once you see the team, that's really the deal. Because if it was me trying to buy a house in Jacksonville and manage it remotely, I know, because again, I don't do toilets. I don't do toilets locally. I don't do toilets in Jacksonville. You know what I'm saying? So I'm just saying that it's just there's a team to handle that stuff. And I know that if I tried to do it myself, I mean, we don't have to use JWB. They probably don't want to know that, right? I mean, they're my properties. I could do whatever I want to do with them. But why would I change with the program that they've set up? So it's I'm on board, if you can't tell. So sorry.
It's pretty
Secret's out,
obvious,
right?
pretty obvious. You're wearing the shirt, man.
Yeah,
All right,
yeah.
let's talk about this profit that we're creating together, man. This is the report that GC puts together for all our guest investors. This, Dean Curry, is your life. All right, so we start off with the client's why, right? When you first come on, that was my experience. You put in here financial freedom, security of passive income, supplemental income, right? We kind of hit on during the call this idea that you have some supplemental income from it, this idea of financial freedom long-term, security of passive income. What do you mean by that?
Well, just again, having a quality team to be able to do this. So I own the asset. I joke that, I've never been to Little Rock, Arkansas, but I know the house is there because I keep on getting tax bills. So I know the house is actually there, right? But it's not something I have to manage. So the security of passive income for me is something that I own this asset. I'm paying the mortgage that somebody else is paying me, and there's a little extra for the good guy, me, but that's the security of passive income for me. And so whether it's in a non-recourse space or a conventional space, the supplemental income is something that, everybody, I always want to have more money than I have, but I'll make do on what I got right now. So.
Yeah, makes sense. All right. So then your lifetime goal of the passive income was $8,000 a month. Your milestone, the number of properties that you want to get to are 10. The amount that you owe here is 5 with an asterisk, because you just closed on 2355 Orchard Street on July 6th, and you're under contract to close on another property here in early mid-August. So you're going to be at 7 real quick.
Yep.
And your year to achieve your current milestone of 2023 is 2023 to get to 10, right? So you got 7 right now in 2022, and your date of next purchase is, I guess, August 2022 is this home under contract. So how are you feeling as far as these goals, whether you're on track of them or not? Are you feeling pretty confident in, has the goal moved up? Do you want more passive income? Is there anything that should be changed here?
Probably not. Again, this was just my goals for JWB. So we're already at, the lifetime goal, and obviously the number of properties. I said we have 25 doors now. So this is just JWB stuff. So I think, and this is quite honestly before we even looked at the 1031 exchange idea. So if my goal was to be at, if I'm reading this right, by 2023 to be at 10, and we're already at 7, trust me, I've got properties right here in Columbus I would love to sell in a heartbeat, but I can't right now for a couple other reasons. But I think that looks pretty good. But I would say we probably will be done for this year and then move in. Is 2023, does it have to be January 1st or can it be December 31st? I want to make sure I have a goal.
Listen, I'm not the keeper of the rules around here, but I'm pretty sure. But I'm pretty sure if you finish 2023 with 10 properties, you've done good.
Doing okay. All right, cool. That's my goal then.
Awesome, man. Awesome. All right. So then this is your portfolio, right? So these are the 5 properties. I see here, they're all kind of around similar price points, right? You bought these all in the 180 range. You got a couple here in the 150, which is corresponding to what you said. You look at the price first, right? So that makes a lot of sense. And I see here that you got one in 2021, September of 2021, then one in May of 2022. then 3 in June of 2022, and now you've got these other ones coming in. Can you tell us, so were these two first ones, are these the ones that you bought in your non-recourse loan portfolio that you refinanced and picked up off of that debt?
Exactly. So the first two, Bobolink and then the townhomes, which I never would have dreamed of doing a new build townhome thing. But again, some of the stuff through being a part of these programs on the Not Your Average Investor Show.com, that people thought, well, because Jacksonville has so much military and things like that, that being in a townhouse is attractive. I never would have thought that before, but it's just part of the education that I learned. So we opted to do a townhouse on McGurt's. Bobolink was a single family, and both of those are non-recourse funds. The next three in June were a part of the 1031, and then the property we closed on in the beginning of July, which isn't on this list. Those 4 properties, one was the other. So we have a townhouse. We have literally both sides of the same building. Next door to each other. One is in our non-recourse and the other is conventional. That's why the prices are the same, because we went into contract right around the same time.
That's a nice little 4-for-1 pickup, right? So you sell 2 homes and you buy 4.
Correct.
That works.
Yeah, and I didn't have to pay tax. I didn't have to pay capital gain stuff. I mean, I know we're
Yeah.
still in that current tax year, but no, that's beautiful to do that. And again, lots of education around that, but it's well worth it. I was joking with somebody years ago that I was fortunate that my parents paid for my way through college, which was great. So I didn't have student debt, but I still have invested a lot of money in real estate education. And, could I have taken some of that money from education and just bought more houses? Maybe, but I wouldn't want to go in blind. And learning what I've learned in the last 5 or 6 years in real estate is just, significantly better for me in the long term, because I know some of the things that are out there, 1031s, the non-recourse lending. And thankfully, those rates are coming down now. But as you can see, the loan interest rates, and if you look at those, you can see those loan interest rates are a little higher than what they would typically be right now, or maybe higher than what we were when we bought those. Because I sold my business, I guess it's a good problem to have, because I sold my business, I'm thrilled with it. But because I sold my business, I don't get a W-2 anymore. And because you don't get a W-2, then there's different qualifications and. So that's why some of those loan interest rates are a little higher. But again, even at that number, I'm still cash flowing, and we're still, my tenants are still paying the rent.
Interesting. Yeah. So we talk about interest rates going up, right? Like you bought them at inflated interest rates already, and they're still performing. That's good stuff.
Right.
This last property. So the first 2 you got, from refinancing, the last, then 4 that you picked up off a 1031. This last one, where did the money come from last one? Is this another investment that you liquidated, or?
Well, the first 2 you said were the 3, and then, I see. So yeah, so Nan and I had actually decided to purchase the McGurt's property, the bottom one there, just because, through some of the monies that we made from when we sold the business.
Got it.
But the way timing works and whatever else, the McGurt's property became available before the Orchard and this most recent one that we're still hoping to close on. So we ended up applying 1031 exchange money to those. So the one that we're going to close on, hopefully in the next couple of weeks here, that will be money then that will have come from a part of the sale of the business that I had. So
awesome. What I find fascinating is that it's 7 properties and only one comes from, your own pocket, really. Like
really.
Else is just coming from other real estate stuff. It's really
exactly. So, my time frame with JWB hasn't been that long, obviously going back, not even a year ago now. But no, I'm very optimistic that it's going to continue.
Love that. All right. So now GC picks out a property that is highest or lowest return on investment, not including appreciation. Here we got that Bobolink Road property. I guess this was your first one, right?
Yep.
Bought in 2021. You had a negative year, 2021, right? You bought it in September. 2022 did pretty good, 6.2%, not including appreciation in non-recourse. So annualized lifetime returns of 4%, but your expected returns were at 2.31. So overperforming the expectations. What do you think
Well,
about
yeah,
that?
and as we learned a couple of weeks ago, you look at the 2021 and I'm like, well, I didn't buy it until September. So I literally bought it in the last quarter, almost the last quarter of the year. And then you have the closing costs and just the acquisition cost and stuff. So it's going to be down. So I look at that as, the cost to get in. And if I can put down that much money that somebody else paid for in Texas, but if I can put that much money down and only show a 0.01% loss in the final 3.5, 4 months of the year, that's a win for me.
Pretty good. Yeah.
And again, we don't talk too much about the importance of cash flow and things like that on non-recourse properties. But again, the more cash flow and I'm just turning that money right back around, I can't use it. And I'm personally, and I'm going to use it to buy more stuff. Not toys, but down the road, I can, that's a whole nother conversation.
Whole other conversation. All right. So here's the overall portfolio review, right? We talk about it from a portfolio level, right? So it's like what all your properties are doing. You've only been with JWB not that long, right? Like it's only been September
months.
2021, right? So 9 months, not even a full year. You've had a total net rental income of $4,422. You've already saved $514 in taxes. You've had total principal pay down of $1,293. And a home price appreciation of $91,000, which in a short amount of time is not too shabby. And again, the inflation hedging, consumer price index, leaving your money alone, you'd be losing 9.1% every day. So instead, you're doing all of this. Your expected ROI up until this point has been 2.6%. Your actual return on investment, if you were to liquidate this thing, including the closing costs and all that, would have been 29.6% of your money. So are we beating expectations? Profound yes. What do you think about this when you see it?
Well, again, going back to this chart includes, what is it, 5 properties? 4, I guess 5 properties.
Yep.
One of them we acquired last year in September. So when we very first started, all the rest of them, we acquired them a month and a half, 2 months ago. And for this, so we don't even have a full year on the one, let alone, 6 months on the others. So I understand it's not going to always be 20% appreciation per year, but with the homes not being built because interest rates are going up and the tons of new businesses coming into Jacksonville, it's going to stay that way for a while, in my opinion. I'm no expert, but if I'm happy with it at 4.6, I'm really happy with it at 20. And even if it drops to half next year or 2 years, that's still double of the original 4.6 that was the under promise and the over deliver.
What do you think? What do you think this would look like if starting in September to now, the amount of capital that you've deployed into this, you would have put into the market? Well,
it depends on what financial planner I wanted to talk to. But I mean, because, I am in my 50s and, so I don't want to be really, really aggressive because again, somebody taught me a long time ago, and maybe it was even Andy Tanner in that book we were talking about earlier. Andy Tanner did a book called 401 Chaos, talked about all the 401 issues that, you can read the book. It's a good book. But he said one time, I think it was him, I'll give him the credit, is that if I have a stock and I say it loses 50% of its value, I'm sure that's never happened before to anybody, but say it loses 50%. It has to go up by 100% just to get back to even. So if you've got a stock that you lose in 50%, well, if you're 20, you lose 50%. I'm like, well, that's going to happen if you're going to be really, really aggressive in the stock market. But again, that stock has to go up by 100% just to get back to where you started. And how often is a stock going to go up 100%? And that's why a lot of people got really hurt, back in the last big downturn. My father-in-law was one of those people. He was heavily invested in something that was a sure thing. And then I remember I was with him on the day that he found out the company was being sold and, boom. And he was 75. So he's not going to have the length of time needed to get back up to where he was when the whole thing went south. So I always try to think about, maybe the market, maybe real estate and all the protections they put in since the 2008, debacle. I was offered those things too. Oh yeah, what do you make in a year? Oh, well, don't you need to see my W-2? Oh, no, just tell us what you make and we'll base the loan on that. Well, all that stuff is gone. Trust me on this. There are new things put into play. So with all of those new rules and regulations and TRID and all these things that are out there, it's really advantageous for the consumer to make sure that they're not going to be really, really hurt. Whereas I still believe the stock market, again, in my opinion, because I'm not a stock market guy, and that's why I have those people to do that. But, just how long will it take to recover if a significant event happens for whatever reason? And we've seen a lot of significant events happen, in the past couple of years. Hello, pandemic. Hello, Ukraine. Hello, gas price. Hello, whatever it is, your political party, whatever it is in your portfolio. What has to happen to recover just to get back into even is why I'm really looking at real estate, just because it continues to perform, whether it's at 4%, 1%, 21%, whatever it is. And if you're picking the right markets and you're using the right team on your side, then you cannot help but to be in a better position and having that education to go along with it.
Really well said, man. I appreciate you expressing that because that was very well synthesized. The last thing that we like to show here is, your returns by profit center, right? You got your rental income over here, did pretty good. You got your principal pay down over here. You got your little sliver of tax savings. And, in just this little amount of time, home price appreciation has been the meat of it, right? So this is illustrating the idea of understanding that if you're in it for a long time and you can count for home price appreciation, it's going to make up the better part of the returns. Dean, you crushed it today, man. Did you have fun?
I did have fun. It was a lot more fun than I thought I was going to have.
I love it.
Because Hervé was down there at the IRL saying, you got to do it. You got to do it. And I'm like, whatever. So,
then I guess we owe Hervé a debt of gratitude for putting you up to it. Appreciate you talking him into it, Hervé. We appreciate our community that, we started at like 20 today and we got up above 30. That is a symbol of a smart guy talking, giving great advice, making more people want to show up. That's you, Dean. So we really appreciate the community showing up in the chat today and being a part of the show and asking great questions. And if you're listening on the podcast, you're watching on YouTube sometime in the future, we invite you to be part of the community. Go to nyais.com. Come hang out with us on a Thursday afternoon. We never take it for granted that folks take an hour of their day to spend with us. And, it's just a real testament. And on this Tuesday coming up is our final part of the Why You Invest Before a Recession, where we've been going through the whole journey of the JWB portfolio. This is part 4. We did the first 4 years, the second 4 years, the next 4 years. This is the final installment of when they really go from like 40 to 300 properties so that you see the compounding effect of all this stuff happening. It should be a good one. GC is going to be back. I miss that guy. But today the MVP, Dean, was you, man. Really, really appreciate you, making time for us, sharing your wisdom. I thought there was some really key things that we hit on today of, how you talk to your wife about it, the value of not being in the stock market and overall just the magic of leverage that you express really well, man. So thanks a lot for coming. Any final words of wisdom?
No, thanks for I couldn't see the chat because I was sort of talking and stuff flying by, but I've seen everybody say thanks for the conversation. Again, it's a great team. Get involved. If you're listening to this later, and trust me, Nan will be listening to this later, got to help me out here. Okay. So it's all good.
Nan, you are a lucky woman. He is a smart man and he speaks very highly of you. All right. Until next time, we hope you had a good time. Hope you joined us on Tuesday. And just remember, if you want to be like Dean and be a wizard of leverage, you just can't be an average investor. See you on Tuesday.